Today I'm going to go over how to calculate the variance and the standard deviation or the risk of a stock. In part one of this video, I calculated the expected return and I used these same numbers, so I recommend watching that first, and it will make a lot more sense when you watch this video. I'll link it in the description below. So go check out part one and then come back to this after you watch that. So just a quick recap, we got three states of the economy. We got a boom state, a normal state, and a recessionary state. Our stock has a different return based on these states of the economy. So there's a 20% probability that a boom state is going to occur, a 50% probability that a normal state is going to occur, and a 30% chance that a recession is going to occur. If a boom state occurs, our stock is going to give us a return of 15%. If a normal state of the economy occurs, our stock is going to give us a return of 7%. And if a recessionary state occurs, which has a 30% chance of happening, our stock is only going to give us a 1% return. So the expected return, we calculated that with a weighted average. We just simply did the 20% probability of a boom state times our return in the boom state of our stock, and we added that to the 50% probability of a normal state multiplied by our return in the normal state, and we added that to our recession, the probability of our recession occurring multiplied by our return in a recession, and that gave us an expected return of 6.8%. So now how do we calculate the standard deviation and the variance? So first, it's easier to calculate the variance, as the variance squared is just the standard deviation. So the standard deviation is the square root of the variance. So to calculate the variance, I'm going to break this down. It is basically the probability of the boom state occurring, so this 20%, and then the return that we get in that state, that particular state. So this is the 20% chance probability of a boom state happening. This 0.15 is the 15% return that we get in the boom state. And then we minus that by our expected return here, which the expected return of our stock is 6.8%, which in decimal form is 0.068. So that's how we get this first one, and then we obviously square it. Then we add that, we just follow the same steps, and then we move on to the normal state. So we add that to the 50% chance probability of a normal state occurring, and we multiply that by 0.07, which is our return in the normal state. Again, and we always minus from that return, our expected return of our stock, and again, we square it. And then we add that, we're going to do it for the last state, to the probability of the recession occurring, and we multiply it by the return that we get in a recessionary state, and minus again the expected return, and obviously this is squared. And when you do that, you get a variance of 0.002356, which in this case we're not going to interpret what this means too much. We're just going to find the square root of this, which gives us our standard deviation of 0.0485, or we're going to interpret it as 4.85%. Now let's answer this question. Assume there is another stock with an expected return of 10% and a standard deviation of 8%. Which stock is more attractive to an investor, and which stock is riskier? We'll start off by answering which stock is more attractive to an investor. We're going to answer this based solely off these expected returns here. So our expected return of this first stock that we calculated was 6.8%, and this new stock has an expected return of 10%. Based solely off these expected returns, this is going to be the more attractive stock, as it offers a higher expected return. Now let's answer which stock is riskier. Remember, our standard deviation is our measure for risk. The lower the standard deviation is, the less risk of the stock. So the lower the standard deviation, the more certainty we have of the return of the stock, and the less volatile and risky it is. So our standard deviation is 4.85%, and this standard deviation of this other stock is 8%. So the second stock is more attractive to investors, and now looking at the standard deviation is also riskier. And this makes sense if you think about it logically. If you could get this second stock with an expected return of 10%, and let's say the new standard deviation is 2% instead of 8%, everyone is going to buy this second stock because it is promising a higher expected return with a lower risk. So why would you buy this first stock above if it has a lower expected return with a higher risk? No one would buy that stock, right? Everyone would go after the expected return of 10% with a lower risk of 2%, lower standard deviation of 2%. However, obviously, that is not the case. As we can see, the higher expected return comes with the higher risk. And that it just makes sense, and that is part of the risk and return trade-off.